The market is moving. Are you moving in the right direction? Stay tuned. Well, welcome to this week's edition of Note School TV. And hey guys, it is the time of the month when we bring you the market update. And today, well, there's a lot going on in the marketplace, so you're in for a treat today. So again, welcome. A couple of things I'd love for you to do for us today. And number one, make sure and like what you see. Number two, make sure and subscribe to Note School TV's channel if you have not already done so. And number three, hit that bell notification. Yes, go ahead and hit that bell notification so that you will be notified every week when we go live at 11:05 Central Time. Also, please keep those comments coming. They mean a whole lot to Eddie and I. It lets us know where you are. And, you know, we can kind of read and see where you are in your journey as far as your real estate investing journey, your note investing journey. So please keep that coming. And also, we want to hear your questions. And please just simply go to noteschool.com/TV. Again, noteschool.com/TV for all of your questions. If you'd like to know more about what we do at Note School and all of those things, keep in touch with us. And again, your comments mean a whole lot to us. So with that, I want to bring on our fearless leader, our chief visionary officer, and all-around good guy, my friend, Mr. Eddie Speed.
Good morning. How are you?
Good morning, man. It is great. It is a crisp 64 degrees here in South Florida. So, man, we are ready for winter.
Oh yeah, you guys are battening down the hatches there on their winter stuff, huh?
Yes.
Yeah, I'm sure somebody in Minnesota would love to share with you.
Yeah, I would say that would be a thing for sure.
Well, it is the November update. And Joe, as you said, the market is moving. And the question is, what direction are you moving as you're watching this? And so we're going to help, you know, the best informed investors are the guys that make the best decisions. And so we are trying to provide you guys with market information. And we're going to talk about some decisions that we're making. Joe, this is actually the time that people like us do the best.
Yep.
Now, a lot of real estate investors are kind of freaking out right now.
Yes.
Right? But the reason they're freaking out is because there's uncertainty about what steps to make. And so Note School, I will tell you, feels very confident that there's a tremendous opportunity. So, Joe, let's talk about housing first. And Joe, this was last year, right?
So that was that was last year, and so that was what was that?
Year in 2021.
So that's 6,490,000 houses that were sold, and then that line kind of drops down, and no matter how you figure that, Eddie, that's over 2.1 million. Drop as far as the existing home sales.
Yeah, we're 1 month away from having a year in total, but we're a couple of million houses short. And if you guys watched Cade Thompson in our market update that he did, or market review that he did, that was from Note Expo, and of course Cade is our friend that literally has $30 billion under management. As he says, Joe, we make billion-dollar bets.
Yeah.
And they're projecting that next year that housing sales are going to substantially drop even more. Yeah. And they're going to be in the 3.5 million range. So, and we're seeing these trends all over the place, but we're going to talk about what this means and why this matters. But if you're a realtor, or you're involved in transactional real estate, you're having to make a shift. There's no question about it, because the number of sales and transactions are down. And what else has changed, Joe, is the drop price is that number's growing, right?
Well, so last year, that number was a house would go on the market in the morning for $500,000, and it would sell for in 3 days for $625,000. Well,
Exactly.
This today, what we're seeing is 24% of home that sold. It was a price drop, right? So there was the asking price, and so 24% of the house sold for less than the asking price versus it going the other way. And that line, Eddie, is almost straight up, right?
Yeah, I was going to draw a little arrow, and I'm not sure. I think my arrow may have more slant in it than that line.
Yeah, and you see that the trends there again in 2020, the beginning of 2020, when down because of the the whole COVID thing, and then of course it started to shoot. There you go.
All right, so days on the market, Joe, those are going up, and we're not at like back where we were at 2000, and 2010 of days on the market and stuff, but we're getting longer. And I think as we see this trend, I think everybody knows that's going to continue as well. Yeah. Joe, this is just a summary. We sort of did this, your slides are available. A PDF of these slides are available in your handouts. And so, Joe, this is really just a summary of a good summary sheet that shows really what we're talking about. And if you notice, we have different people that we're sourcing this information from. Joe, amazingly, they're pretty much all saying the same thing.
They are all saying the same thing. And if you see there on the bottom where it says the average 30-year fixed rate mortgage, that was from October. And remember that, again, these are the latest stats. I know this is the end of November, but, we have a full month there. And that's because the rates didn't really start ticking up over 7% until kind of mid-October. So that's why you see that average rate at 6.9%. But you can see year over year, 3.83 points. And then,
that's still at 6.9. Take it to 7.5, and it's a horse of a different color. Another number I think, Joe, people would find 31% down in home sales.
Yeah.
New listings are down 24%.
Yep.
And a lot of that, by the way, are home builders.
Yes.
And so we've gone from a supply chain issue that is still down, but once again, we have sales that are down. So,
and Eddie, I think maybe is there some kudos to the home builders at this point, because they didn't continue to build and build and build, because if you can control the inventory, you can somewhat control the price, right? So I think
I believe a lot of that to do, Joe, is that their lenders have helped them make some decisions.
Yeah.
Let's talk about mortgage lending.
Let's talk about it.
All right. So mortgage rates here, Joe. This is from Bank Rate and mortgage rates. And Joe, this is the effective interest rate.
Right.
Okay. So what this means is this rate includes the closing cost, the points, essentially the markup in the loan. It's not what the interest rate on the loan is, but it's the APR. And these are average rates. Joe, you know that this is not only the best people get this rate.
So Eddie, that rate was for people between 720 and 750 with 20% down and the DTI, the debt to income ratio, fitting right in that perfect box, right?
So basically, if you didn't have that level of credit and that down payment, then you're worse on the rate.
Right. You're ticking.
All right. So obviously, when you see rates going up, essentially, Joe, they've doubled.
Yeah.
Right. And more than doubled, actually. Yeah. And really, when you see that, Joe, it's not surprising that last year, 2021 originations, we were almost at $5 trillion.
It's a big number.
And this year, we are going to basically be at half of that number. And next year, they're projecting that it drops even worse.
Yeah, I mean that's a big swing. Over $2 trillion between last year, between 21 and 22, and that's a big number.
Joe, only really a politician can sling that trillion number around and act like it doesn't mean much. You know what I'm saying?
Yeah, there is a number bigger than a trillion, but a quadrillion, I don't know, but it's a lot.
Don't tell our politicians that, okay?
Right.
All right. So as a result of that, we see a lot of names in the business with layoffs, and certainly, Joe, they've accused of unethical behavior
in their layoffs, right?
Yeah.
And again, when you cut your volume by more than 50%, this is just what's going to follow, and that's the servicing industry too. Mr. Cooper is the biggest loan servicer and probably in the world, I know in the United States as well. And this is just their latest employee layoff. Yeah,
Joe, I will tell you that I think that all of the headlines, and it's almost every week we see the headlines of mortgage lenders having financial woes. I think it is. Mark my words on this, guys. It's a tip of the iceberg, right? There's a lot of going on underneath. Right.
And Eddie, it's those non-bank lenders that are really being hit, like the Rockets and the Loan Depot and those as well. So more to come on that for sure.
Non-bank mortgage originators. Yeah.
Yep.
So when mortgage lending is really good and money is easy and cheap, you don't see a lot of creative financing, Joe. Just a little bit on top, right? Just a little bit of creative financing there. But when money is scarce and underwriting is as tight as it's been since 2011, and money is expensive, all of what we've seen on the rates so far, and what you see is seller financing, right? And seller financing filling that gap.
Yep.
It's for that buyer that's been left behind, what we call that penalty box buyer, and also buying on terms. And the sellers carrying the terms for the real estate investor. And Joe, this is what Note School is laser focused on as far as new real estate activity. This should fill a gigantic gap in the market, and it does for those who know how to do it. And for those that don't know how to do it, I'm going to say that goes in with your headline, Joe. The market's moving. Where are you moving?
Where are you moving? And we look at that, the Mortgage Credit Availability Index, and the new one hasn't came out yet. We don't have it on. It won't be out for a couple of weeks. But, that was back in March, April of 2020. It was at a 185 level. And, the last one was at about a 102.
185 is the mortgage credit availability. So in February of 2020, the mortgage index was at 185.
Right.
In October of 2022, it is at, call it a 100. And so this defines what we're saying as far as who can get a mortgage, right?
That gap.
And it's not just rates, it's how tight their lending is. So it's a variable in the market. And this if you're not getting that, you need to get that. You need to get that. This is why we thrive when things aren't good in other areas. All right, let's talk about real estate investors a little bit, Joe.
Let's do that.
So I'm involved in a number of real estate masterminds that I would say that of the top 500 house buyers, by far the largest percent of all the top 500 house buyers in the country are a member of one of these masterminds. I've spoke at 5 of them in the last month, right? In some way, shape, or form, either virtual or live or something. And the answer is that these guys really, really, really have been affected. And the reason is that when they were going and putting a house under contract and flipping that contract, they were flipping predominantly not to consumers, but to investors.
That's right.
And when the investors have gone away, it's drastically affected the flipping business, not in a good way.
Yes.
Okay, so let's look at what's happening in the investment business. Joe, let's look at the rent tracker.
Yeah.
And what you see here are Joe, say it ain't so. Are you telling me that it's going down?
It is finally trending that way.
Yeah.
The slowest growth in 14 months. And it's, they've been dropping, for the first time in 6 months. Yeah.
Yeah. So really, that's one thing I would say. People always I read a lot in the Facebook pages and different things, and I'm sure you guys do, and hear different things. And they say, yeah, I'll tell you one thing about inflation. Inflation means you're always going to make more money on your rentals. And I'm going to say to you that living and doing this business since 1980, I'm going to say to you that is a very arguable subject. I'm not saying that can never be true. I'm saying it isn't always true.
That's correct.
And what we see now is rents are actually coming down because people can't, the affordability factor. But guess what is always still going up, Joe? Your expenses.
Your expenses.
And so that's why we have entered what I believe is a note cycle. We have rent cycles and note cycles.
Yes.
Right. And so this, Joe, I think is probably the most unimportant chart of today.
Yeah.
You want to know what's happened to wholesalers? You want to know what's happened to the wholesale business? That right there. That
and Eddie, look at that swing between, what is that? The third quarter of 21, you got 141.1, and then now you're below zero at 30+%.
Joe, in literally in 1 year, you went from this all the way down to this.
Below.
Right? That's 170% swing.
Yes.
And that's what's happened in the house buying business, right? If you want to know what's happened, they're selling to either hedge funds or they're selling to HGTV type buyers, right? Yeah. People that watch HGTV and are going to buy a rental. And all of them, because of rates, have drastically changed their model. So, Joe, JP Morgan is jumping in there. I'll tell you a little thing, though, Joe. They're jumping in there not in buying existing houses, but they're jumping in there and buying, doing build to rent.
They're going to build to rent, absolutely.
And so they think what they're thinking is they can control the cost with build to rent. They can't control the cost in buying existing houses.
Right. They can buy large tracts of vacant land and build it and build something that's going to last. And yeah, with their partner they're it's a joint venture. And so they inked the agreement, and they're going to start building as soon as they can. Yeah.
Right. This is going to affect the building market in that area, but it's not going to affect it nationwide. Builders permits are way down. Let's talk about consumer debt, Joe. We better keep an eye on this, right? Yeah. So revolving debt, Joe, and if you look at where we were in 21, and now look at where we are ending in 22.
So we were talking about that T word, right? That is one. I had to kind of figure that out, Eddie. That is $1,153 billion, and that's a lot.
Okay, and here's the difference, guys. Look at what it was 1 year ago.
Yeah. Right?
1 year ago, we were essentially at this number. It's even lower than that, Joe.
Yeah.
We were at this number right here.
Right.
And now all of a sudden, we're at, well, let me find a different color so you can actually see it. Joe, we were here, and I know my line's not perfect. And now we're at here, and as you said, 1,000 billion is a trillion.
That's right.
And so we're over a trillion. This is like really something to pay attention to, right?
And Eddie, I mean, that just kind of goes into the vein that people with inflation and with the cost of things, people are they're going to their credit cards, right? And when I put this together, the average interest rate on a credit card is 21.99%. That's the average.
Wow.
Yeah.
All right. Now, Joe, this is another chart, and this is from the Federal Reserve. This is
Right.
This is from the New York Federal Reserve. And of course, this represents non-housing.
Right.
And of course, the blue represents housing debt.
Right.
And I believe, Joe, that it's pretty obvious to say that we're trending up. And this is definitely the consumer is trending up, the consumer debt.
Yes.
But also housing debt. And once again, this is going to be something that's going to get watched. And Joe, I just say that we're at new highs.
Yeah, and Eddie, when you look at it, back in January, if you had the number everybody kind of throws around as a $320,000 mortgage based on a 20% down in a house being $370 or $380, but the payment went from at 3% from $1,200 a month to at 7%, and we're looking at $2,000+ a month. So yeah, you can see. I mean, it's all related, right? This is all together.
Well, this is going to be something to pay attention to, and I know that the Federal Reserve is paying attention to it. Sure. Let's talk about non-performing loans. And Joe, this is the latest from Black Knight.
It is,
and it's painting a picture that tells us kind of the bottom line of things is the number of properties that are 30 or more days past due or in foreclosure in both categories. Joe, we're at 1.7 million mortgages.
Right.
1.7 million mortgages are 30 days past due, or they're already in foreclosure.
Right.
And by the way, we have a big number of loans that are pretty seriously delinquent and not in foreclosure yet.
Right.
And that's this number right here.
That's it. Yep.
So understand that we're watching that like crazy because that's the inventory yet to come. And our properties that are in foreclosure is really a low number. Now it's higher than it was, but honestly, Joe, it's a low number.
It is, and Eddie, I mean, again, you had that period of time where there wasn't any foreclosures, and now, I mean, it's only been since January that the moratoriums have been listed. So it seems like a long time ago, but it takes a lot of time to push those things through the system because you've got to offer them because of the rules and CFPB. You got to offer a mod for them or whatever it is before. And you know what else is going up, Eddie? The where you push the payments back to the end. I can't remember what it's called. Forbearances are ticking up again. Yeah.
Well, Cade talked about that in his presentation, and he said we weren't going to see an avalanche. But I would say an avalanche is what we saw in 2008.
Right.
Well, when he said, he didn't say that there wasn't going to be any non-performing notes.
Yeah.
Because you're looking at just a tick under 2 million, right? And this really hasn't solved. We've been talking about this since the virus started and all this, delinquency, and it got to a certain number. And Joe, this is what we call the sludge.
Right.
And the sludge, when it doesn't clear out, it ends up going out the end as foreclosure. And if you watch this sludge number, Joe, if you look at it literally for the whole last year, it hasn't moved very much.
No, it has not.
And so this is a pretty significant thing to pay attention to. And Note School is very active, obviously, in the non-performing area as well. So,
and Eddie, one of the things I want to say about that too is when you put the human factor to that. I mean, you say, well, it's only 2 million, right? You could say that, but that affects, average family being 4 to 5 people. I mean, that affects 10 million people, right? I mean, so that's when you look at that, there's a huge human factor to that as well.
Yeah, it is. And a lot of these foreclosures they're equitable. They could put the property on the market and sell it.
Yes.
And so and get and pay off the mortgage and have money left. And hopefully that's what we'll see them do.
Yes.
But it shouldn't have to end up at foreclosure in a lot of cases.
Right.
All right, so Joe, these are stages of delinquency right here, and this is a big deal because this is comparing this year versus last year.
Right.
Okay. And so the current to 30 days, Joe, we're kind of dead on the money there.
We are. Yes.
Both ways.
Yep.
Right. Nothing. We're not any different in that regard. The 30 to 60, we are slightly less this year than last year.
Yep.
Which I think is a reflection of, people that were affected by the virus. Hopefully they're, kind of out and they've all got a job and are doing good.
Right.
But here's the other thing, Joe. This is what leads us to loans that become severely delinquent. We pay the most attention to 90 plus days delinquent.
That's right.
But we watch this 60 to 90 trend. Everybody in the business will tell you, and we're still, this trend is why you see this number not going down.
Right.
And the 2.7, the 1.7 million loans that are delinquent.
Yeah.
And by the way, Joe, this number is way bigger than this 90-day loan. Joe, this percentage is way bigger than this percentage.
That's right.
That is not going in the right direction.
That's right.
Right. So guys, here's the thing. Okay. The thing I'm going to say to you is the opportunity is now.
Yes.
The opportunity is now. It's not, is there an opportunity? There's absolutely an opportunity. Yeah. And I wanted to kind of tail us off at the end of the day here to say, because somebody could watch this and say, well, these guys aren't really giving me very good news. And the truth of the matter is, in the economy, there's not very good news.
Yeah. Yeah.
Right. The mortgage, the housing market, the house flipping business, the house buying business, the mortgage business, all of those things are not good. But Joe, those black swan markets, and I've been doing this since 1980, and you've been doing it since about around 1990.
Yes.
Right.
Mm-hmm.
Those black swan markets are our opportunity.
That's correct.
The question is not whether there's an opportunity. The question is to the audience, are you seizing the opportunity?
Right.
The market is what the market is. The direction that market's going, that we're going to see a decline in real estate values. We kind of peaked out earlier this year, and then all of a sudden we're seeing a decline in most markets. It depends on the worst markets are what they are, basically Denver and West.
Yes.
And but all markets are kind of being affected, and I think it's pretty clear. Joe, you and I would have bet that supply and demand was the most important single variable in any trade market.
Right. Yeah.
But what we've now looked and seen in this, and we're still learning, just like you guys, right? Because if you'd asked me 2 years ago, Eddie, what's the most important thing? I'd have said supply and demand. Yeah.
Yeah, for sure.
But here's the thing. The demand is the problem.
Yes.
And the demand of consumer sentiment and people wanting to buy properties, lowest it's been in how long, Joe?
20 years.
Lowest, people thinking that real estate is a good investment.
Yeah.
It's the lowest sentiment. In other words, people belief about whether it's an opportunity. It's the lowest in 20 years.
Yeah.
Now,
and that number is going up. The sentiment is going up as well. And the fractured closings, which, we talked about earlier, that's up 23% or something as well.
Yeah, fractured closings are deals that go under contract and don't close, and we're breaking records of the number of transactions that go under contract yet are not closing.
Yeah.
I have it on pretty good authority that house flippers, people that are wholesaling deals, that their number is much higher than the national average of just fractured closings, period, and that their number is closer to about 75%. 75% of wholesaler contracts end up in a deal that didn't close.
3 out of 4.
I have that on authority from people that facilitate these large masterminds that I'm involved in, and I believe these guys know what they're talking about. So the deal is this: where is the opportunity in the middle of this? And the opportunity in the middle of it is because of creative financing, the knowledge and the expertise to go implement that in today's market puts you at a unique advantage in the real estate world.
Yes.
Right? Real estate and financing sometimes don't have that much to do with each other. Sometimes it has all to do with each other. And right now, I believe that we've entered a market where the positioning creative financing versus how you're effective in real estate investing is huge. As far as the note world, the amount of seller financing being created, the amount of non-performing notes that are coming down the conveyor belt, those are all reasons that we look at it and say, Joe, the activity level in our business is probably the opposite of the regular wholesaling business.
Oh, yeah.
Their business is dropping, our business is increasing. And what we want to say to you guys is, we speak from experience in this but we both got a little gray hair. The water is fine.
The water, come on in. The water's fine. That's right.
You guys remember the you can get your slides that we just went over. The last slide on there has how to reach out to us and contact us. If this sounds like something you're interested in, then you guys do that. And Joe, what do you think, pal?
Well, here's what I want to say. I want to end on a really positive and happy note. And so what I want to say, and what I want all of our followers and the people that are on, I want you guys to wish Eddie a happy birthday. Today is his birthday.
It is true. Today is my birthday. Yep,
so November 30th back in 1929. No,
yeah. Well, it was 1959, but yeah, no.
I'm always going to be a couple of years older than you, Eddie. There's no doubt about that.
Yeah. Well, thank you. We've spent a huge amount of time talking to people essentially that are sort of reinventing themselves right now. And our team does this really on a daily basis. We're not happy that things are changing and causing stress. What we're happy about is we know how to do something about it. Right. We're not happy that it causes people in a stressful situation, but if you know what to do, it changes your perspective and how you see the future.
That's right.
Right. That's my words of the day. Joe, as the old mayor of Luckenbach, Texas once said, I'm out of soap.
Very good. Guys, we'll see you next week. Take care.
Right. Bye-bye.